Number one, the first goal, the first policy goal for tax, for any country's taxation system, for any country's tax professionals or policy makers, the first goal is the goal of maximization of revenue considerations, isn't it? You pay tax, I pay tax, government collects taxes, number of taxes, for what? For revenue, for maximizing the revenue. Okay, so first is revenue considerations. Why would the government need the revenue? Government needs the revenue for creating public infrastructure, for social sector, health, education, child welfare, women welfare, roads, industries, defense, right? Revenue considerations, government expenditure, financing the government expenditure. Revenue consideration is the first most important consideration for any tax. Revenue considerations are also very closely related to the concept of tax base. So every country tries to preserve and tries to maximize its tax base. Very commonly used term. I am sure you would be aware. You would have heard this word tax base number of times. What exactly is meant by tax base? What exactly is meant by tax base? See, tax base includes income. It includes income. It includes property. Income, property. Property, what property? Property, real property. Land, real estate, land, buildings, homes, houses. Property, real property. It includes intellectual property, IP. Tax base includes income, property, real property, intellectual property. It includes assets. What assets? Tangible assets, intangible assets. Intangible assets. IP is a type of intangible assets, right? Income, property, assets, consumption, transactions, and other economic activity. These are the elements of tax base. Tax base includes income, property, assets, consumption, transaction, and other economic activity which is subject to tax in a country. This is the definition of tax base. Very wide. Income, property, asset, consumption, transaction, other economic activity which is subject to taxation in a country forms the tax base of that country. And it is the endeavor of the country to preserve the tax, to maximize the tax. Wider the tax base, better it is. Revenue would automatically increase. Narrower would be the tax base, there is a problem. India is a very big country. Now it has become the most populous country. Till few years, if you go a few years back, 5, 6, 7, 8 years, tax base, you know what was the tax base of India? 3%. Out of 100 people, only 3 persons used to pay tax. Now it has increased, but it is still very much under 10%. Tax base is narrow. When the tax base would be narrow, the people who pay taxes, they have to pay a higher share of tax. India is still a developing country. This is a major problem with developing countries, that their tax bases are narrow. Developed countries, tax base populations are in any case less, and most of the people have to pay taxes. Tax bases are wide. Right? So revenue consideration very very important, and tax basis. This is the first consideration for a tax system. Number one. Number two. I hope I am clear. Johnny, is it fine? Mr. Altaf, Mr. Ali, Charan, is it fine?
Sir, you are talking about direct tax, but we all our people pay indirect tax.
Consumption.
In form of indirect tax.
Consumption.
So, the number of you just told that number of people it's out of 10 only 3. But
that is basically about the income tax I am talking about. I haven't used the term direct taxes or indirect taxes till now, and I will not use these terms throughout the discussion, because we are discussing in PIT tax treaties, we are discussing the income taxes. As far as indirect taxes are concerned, GST, that is goods and services tax, that we have in India, that is basically a form of VAT, value added tax. Fine. Loosely speaking, that becomes an indirect tax. But you know what, I'll show you, I'll take you tomorrow to the paragraph where it is very clearly mentioned in the tax treaties, model tax convention, where they say that indirect tax and direct tax, these two terms are very very vague and imprecise, and that is why we will not use. So similarly, I will also not use these terms direct or indirect taxes. When I said that 5% or less than 10% was the tax base, I meant the income tax. Let me be clear. Fine. As far as in this definition of tax base, when I have written the word consumption, so this takes care of your consumption taxes, VAT, etc., GST. Fine. Right.
Fine, sir.
So this is the revenue consideration, number one. Number two, you have considerations of equity or fairness. Equity or fairness. Consideration of equity or fairness. Fairness. Horizontal fairness or horizontal equity. Horizontal equity. And second is vertical equity. Vertical fairness or vertical equity. Horizontal equity. I am an international tax consultant. I am an international tax teacher. Other person might be a farmer. Other person might be an industrial worker. Fine. Some other person might be engaged in some manufacturing activity. But all of us, if all of us are earning the same amount of money, then we should all be taxed at the same level. This is horizontal equity. People earning the same level of income, should be taxed in a similar manner. This is horizontal equity. Same level of taxes. Vertical equity, higher you earn, the more you should pay. Because this is based upon the ability to pay principle. Because if you are earning higher amount of salary or higher amount of income, then your ability to pay is higher. Fine. So the more you earn, more you pay, and people earning the same should be taxed in a same fashion. These type of equity, these two equities are at the root of the taxation system of most of the countries. Fine. And that is why you would find that in most of the cases, at least in India, that a certain minimum level of annual income is exempt from taxes, that is tax free. And this would be true for most of the countries. Fine. vertical equity is achieved by progressive system of taxation. Progressive taxation. Progressive taxation system. Progressive taxation. For example, 0 to, I mean hypothetical, 0 to 500,000 tax nil. 500,000 to 1 million, say for example 5%. 1 million to 2 million, say 10%. So you see, higher the money that you make, higher would be the income tax slab. This is known as progressive taxation system. Fine. Vertical equity and horizontal equity. Second consideration, very simple. The goal of fairness. Third, tax competitiveness. Competitiveness considerations. This is for my throat. Don't think that I am having something else for my throat. Fine. So number 3, third goal. Competitiveness. All of you would have heard the term of the name of tax havens. Tax havens. Tax havens. Can all of you give me one name each of the country or the territories which are termed as tax havens? Raghu.
Mauritius. Mauritius, sir. Amen.
And Mauritius.
Okay, Krigan. Altaf, Ali. One name each.
Here,
Which one?
in case, in Middle East, of course, it's Dubai so far, but now they will post city also.
Okay, fine. Neha.
So UAE and Mauritius. The Seychelles also is the tax.
Fine. Mr. Ali, I'm yet to hear. Mr. Ali, are you able to hear me? Ali. I am not able to hear you, but yeah, tax haven. Can you give me one example? By any country?
Bermuda.
Yes. See, he spoke and he gave me the best name, Bermuda. Whatever you are mentioning, all the others, Mauritius fine taken, Dubai fine taken, but these are the real tax havens. Bermuda, Gibraltar,
Cayman Island.
Caymans, Guernsey, Jersey, Isle of Man, and what else? You know, even Switzerland, even Netherlands, although these are European countries, these are the tax havens.
Sir, Singapore is there?
Singapore, I won't say it's a tax haven. It's normally not mentioned. Singapore is a very fairly advanced. I will not say that Singapore is a tax haven. Fine. It might be having some favorable. I mean, I'll just give to you the considerations or the factors. Fine. Don't worry. But these are these examples. Malta, tax haven. Even Cyprus. These examples, these are known as tax havens. Why tax havens? Tax havens, simple policy, zero level of taxation or next to nil. Zero level of taxation next to nil. 0.1 or 0.01%. What happens? As soon as you create a zero level of taxation, suppose this is Bermuda. As soon as you create, even Mauritius is also a tax haven. I am not denying that. And you create a zero level of taxation. What happens? Multinational companies all across the world, they start rushing into this area. Why? Because they don't have to pay any taxes on their income. They can keep their income in the tax havens for an indefinite amount of time. All the investments, they also start flowing in. In fact, those financial routing, financial companies, etc., they still have their headquarters in these tax havens. But the situation was very bad till few years back. I'm not saying that tax havens have disappeared or they will disappear. I'm not saying this, but it was very bad because till few years back, at least before 2013 or 2015, before the initiation and completion of BEPS 1 project by OECD, base erosion and profit shifting, countering BEPS, governments didn't even have the tools to counter the tax haven. They didn't even think of countering. Now what happens? See, when you create a zero level of taxation, everything starts flowing here. Now the neighboring countries, this tax haven starts having a suction effect. It starts sucking everything from these countries that starts flowing here. Fine. What is the option? What was the option for such countries, for these poor chaps? They also have to reduce their tax rates. Fine. So they reduce their tax rate. Other countries, they would also reduce their tax rates. And this would lead to a race to the bottom. I will reduce my tax base to 10%. My neighbor will say, okay, you are reducing your tax rate to 10%. I will reduce my tax rate to 9%. 10, 9, 8, 7, 6, 5, 4, 3, 2, 1 and nil. Ultimately, the country which would have a nil tax base, revenue considerations, how would they make money? How would they gain money? How would they carry out infrastructure, education, health, infrastructure works? Beggar thy neighbor. Typical name of this policy used to be beggar thy neighbor. I will make my neighbor beggar. Beggar thy neighbor. Tax havens, this is known as beggar thy neighbor policy. Ideally speaking, for investment, for seeking investment, tax consideration should not play a role. The real considerations of investment, the real factors that should encourage investment are what? Are a good infrastructure, education, the education level of your population, the skill level of the population, the political stability of the country, the investment climate of the country, ease of doing business. These should be the considerations for investment. But tax havens, they completely make a mess of this tax competitiveness. Fine. So this is a very, very important consideration, that your in order to become tax competitive, countries they engaged in a race to the bottom. Completely, nobody gains out of this. Nobody gains out of this this policy of race to the bottom. Only multinational enterprises, they gain, because wherever they go, they end up paying a very next to nil amount of tax. Very, very important. Fine. Competitiveness considerations. Number 4. Just a small update. 2-3 days this last week, I read an update on LinkedIn. Many countries of the world, they are now implementing, they have come out with proposals to implement Pillar 2 reforms. Global minimum taxation, 15% minimum tax rate. GMT is basically global minimum tax, or Pillar 2 is basically for countering this. They say that the proposal is that wherever the multinational enterprises will operate, they should pay a minimum level of tax. That minimum level is set as 15%. There are many rules, it's very complicated, but then this is the rationale that nobody should be able to reduce, no country should be able to reduce the tax rate below 15%. The update that I am talking about, that was about Bermuda. Earlier I mentioned about Bermuda. What was that update? Pillar 2 rules are very complex, very complex, super complex. Full-time tax academicians, full-time tax professors, they are also pulling their hair. They are conflicting. Many, it will take a lot of time to make a sense of those rules. What Bermuda did, that was an update. What Bermuda did, Bermuda achieved. I'll come to that. What Bermuda did, Bermuda cut through the entire complexities of Pillar 2 and has come out with a proposal that simply imposes, I think, 15% tax. So in a way, in effect, they are trying to achieve the same goal of Pillar 2, cutting aside all the complexities. So I wrote a post actually. I wrote simply 2 lines that this is a very smart move by Bermuda. And then I wrote, tax havens have always been smart. Right? So this is the point. Mr. Altaf has asked, what is the key takeaway for tax competitiveness? The key takeaway is the tax systems of the countries have to be competitive, or at least they used to engage in this tax competitiveness. That because your tax rate is 10%, let me be competitive, let me reduce my tax rate further. One of the considerations. Fine. And with this Pillar 2 coming into picture, OECD last year has released a document that has certain proposals for providing tax incentives, because a zero level of taxation, this is the biggest incentive. So now what they're saying, that if we are not able to reduce taxation below 15%, we will give some other incentives. Fine. So this is the key takeaway.